The Fed is in the process of raising policy rates at the fastest pace since the 70s. Since March, they have increased rates by 2.25 percentage points. The US Central Bank has also started to roll back extensive asset purchases, bond purchases. One of the key questions that investors in fixed income have now is, have we already seen the peak in US yields at 3.5% earlier this year? It's closely related to the question about, have we already seen the peak in inflation? There are two competing views on how the inflation story unfolds. It boils down really to the pace of inflation declines. One camp, which is aligned with the current market pricing, believes that inflation is close to peaking and that a few more Fed hikes will, aligned with the falling inflation, bring the two in line. So the rates will be above inflation by mid-2023, and interest rates at this level will be restrictive to economic conditions, but not too restrictive, so short and shallow recession will ensue. The opposition counters that inflation is not likely to come fast enough and that central bank will have to hike interest rates further and more aggressively than the current market pricing before the rates are decisively above inflation. This group argues that the Fed funds rates will have to be at the minimum above 4.5% before necessary inflation wringing out occurs. It will take actually quite a bit of time before we know which side is right. The adverse effects of higher rates take usually about a year to flow through in the economy. In the meantime, the US 10-year yields are likely to trade in a broad range on both sides of 3%, with inflation data being the key driver. We wonder whether investors are giving a bit too much credence to arguments that the worst of inflation is behind us. In such an environment, our preference is to follow nimble trading strategies in the portfolios rather than align closely with one of these views.